So everybody, first of all, thank you for being here. This is a really part one of a two-part webinar on selling your business. And I'll go a little bit more about what this part one is. Part two is going to be, I think it's already scheduled. Actually, we'll let you know the details ASAP, and this group will be included in the details first. But part two is going to be probably another month or so. But we wanted to talk first, get this first part done, and I'll tell you more about what that means in just a second. So this two-parter is going to be all about selling your business and what that actually means. I'm only going to keep the screen sharing going for just a few minutes while I do the intros, and I'm going to turn it off so we can see the panelists a little better. I'll go briefly through me. A lot of you know who I am already. I am the founder and CEO of Cruise & Co., lifelong entrepreneur and business consultant. I own a company called CE Painting, which is a commercial painting company, pretty sizable firm. We work with large GCs all over the United States. Both of our firm, also the finance company, we own the finance company as well. So I work with three separate leadership teams. Both of our companies have been on the Inc. 5000 last year. CE Painting almost broke the Inc. 500 2 years ago. All of our firms are organic growth companies. We don't take on any capital, and our firms do a total of somewhere around $20 million, and we have around 70-ish headcount at this point in time. I also owned a company called Collegiate Entrepreneurs for many years, teaching college kids how to run painting businesses. I actually sold that business. And while I owned Collegiate Entrepreneurs, this is really how I learned how to scale businesses. I had somewhere around 11,000 employees during the time that I owned that firm, and we were all over the United States. So I built that firm, sold that firm, built the consulting company, started the commercial painting company along the way. Now I work with three leadership teams, and I'm all about entrepreneurship. I was also an EOS implementer for 8 years. Loved that firm. It was a great system to work with. I was grateful for that experience. And personally, I've run over 1,000 full-day meetings with clients as well. Some more about Cruise & Co. We have, I think, a team of 13 consultants. We work with about 110 plus clients across the United States and into Canada. And that's me. The firm itself, most of you know all this. Our mission is to help entrepreneurs and their teams live their ideal lives. Our ultimate goal is to become a Deloitte for small and medium-sized companies. We want to be the consulting firm that small and medium-sized businesses just don't have. Our niche is helping entrepreneurs increase the revenue, profitability, and valuation of their companies. That is our focus. We are a consulting company. Yes, we get compared to EOS and scaling up and all those things. Yes, we do. And we love those companies, our competitors, but we are a consulting company. Yes, we have a system. It's called the growth method, just like other companies do, but we are a consulting company, and we measure our success based on increasing our company's revenue, their profitability, and their valuation. Our target market is small and medium-sized businesses that range in size from really about $1 million, is kind of where we start with companies usually, as long as they're scalable, up to about 999 employees. And we do have firms we work with that are from about $1 million up to about $500 million in revenue. So our goal was to be able to build a company that focuses on both small companies and medium-sized companies, and perhaps more importantly, helping small companies to become medium-sized companies if that's their goal. Our value prop is we have a full company system called the growth method. Our success in helping clients hit their numbers and the resources clients need to succeed. We have a finance company. We have partnerships with recruiting. We have operations partnerships. Really, whatever companies need to run their businesses, we try and provide that service to make sure we are a full-service consulting firm, including helping them sell their businesses, partnering them with wealth management, as you'll see in a second, et cetera. So we are a consulting firm for small and medium-sized businesses. Let's get into the people that matter here, though. Look at this picture. Darren, that's the most confident picture ever. Look at you. Darren Fredette works with us. He's a strategic partner and senior advisor in our firm. He brings invaluable expertise in operations and investments. He possesses a wealth of experience in strategic planning and financial management. And Darren was not only, he's like the hair club, remember that advertisement? He's not only a member of our team, he was also a client for years. He recently led the financial operations and corporate strategy for a cutting-edge thermal shipping solutions provider catering the biopharmaceutical sector. They had a phenomenal exit, which means that we lost a client. That part stunk for us, but it was great for Darren. Darren, raise your hand so we can all see you. There he is.
Thanks, Eric.
Yeah, Darren he's our CFO. He's a strategic advisor for a lot of our clients, but he's also our CFO, and we couldn't be more proud and thankful to have him here as a team member. He's just awesome as a human being as well. Speaking of awesome human beings, Charlie Henry is here. He's a 4-time owner and co-founder. If you're an entrepreneur on this call, he is one of us. He's truly one of us. 4-time and co-founder in the veterinary services field. From 1996 to 2014, Charlie opened 3 veterinary offices and acquired 1. I won't give away his whole story, but he's a typical client for us. He started very small and built that thing up from scratch. I remember when he was very small, and I remember when he wasn't. So he is truly, if you're sitting there thinking, well, I'm a much smaller business, so was Charlie. If you're thinking I'm a much bigger business, so was Charlie. Charlie developed Cape Cod Veterinary Specialists into a multi-location company in Massachusetts with locations in Dedham, Buzzards Bay, and Cape Cod. Charlie's 27 years resulted in the successful sale of all 4 businesses, marking a significant culmination of his career. He's also a very dear friend of mine. We've been talking about entrepreneurship for the 30 years we've known each other, and he was with our client of ours for 5 years. Also another wonderful human being. I'm very thankful that he's here. Charlie really is the star of the show. He's us. He's an entrepreneur, and he wasn't planning on selling, and he did. And I'm gonna let him talk a little bit about what that was and what that meant in just a minute. Another wonderful looking guy, Derek. I chose not to put the CrossFit picture up there, Derek, although it was tempting. Man, he's a managing director and wealth manager of a very large amount of assets, which we won't talk about, but he's very successful in what he does. He's a managing director and wealth manager of First Republic Private Wealth Management and a partner of Cruise & Co. He probably is the wealth manager for probably 25% or more of our clients. He's a partner of our firm. If we could make a person who runs this much assets a team member, we would. He's as close as they get to being a team member of ours. He's a very important part of our process. He's one of Forbes Magazine's top wealth advisors in Massachusetts for 2018 through 2022, certified private wealth advisor, exit planning advisor, retirement planning counselor, and accredited asset management specialist. Derek knows what he's doing. So our panelists are Derek, Charlie, and Darren for this. And of course, I'm going to be asking some questions as the moderator. We are going to have some time in the end. I'm going to stop sharing my screen here for a minute. I'm going to go right to the questions. I'm going to be asking today, after I go into a brief intro, I'm going to be asking today 7 questions. And I'm going to tell you what they are. And then at the end, we'll have time for Q&A. 1, what does it mean to sell a business? What does it actually mean to sell a business? 2, when do I sell? When should that be? 3, what advisors do I need to get involved with in order to go through a transaction? How do I estimate what my business is worth? How can I increase that worth? How do I protect my team? And what should I expect my role to be after I sell my company? That is our agenda today. So, and then we're gonna have time for some Q&A. So let me go a little brief intro here, and then we're gonna start going through those questions. And then we'll have time for any of you to ask questions of our panelists as well. As I said, this is part 1 of a 2-part webinar. This part is honestly of the 2, although the second one, you're gonna, if you come to that, and I hope you do, you're gonna say, wow, now I know how to do this. And you are. The second one's we're gonna have a wealth, we're probably gonna have Derek back on for that one. We're gonna have Darren there. We're gonna bring an M&A person who I think may even be here on that, who specializes, who actually helped Charlie do his transaction. We're gonna have him here, and we're gonna have an attorney. So we're gonna teach you how to do that whole transaction, what that looks like in our next webinar. But really more importantly than that for me, as the person whose whole life is dedicated to helping entrepreneurs, more important than that for me is that I kind of share my little brief story here as to why we're doing this and why we even built this firm in the first place. This webinar is really the result of really what is a passion project for me, which is helping entrepreneurs, especially small and medium-sized entrepreneurs, to create wealth in their business. And honestly, for all of you, and including me, I'm a client of myself as well, to have the resources to achieve wealth and success that you just, we don't usually have access to. We're a very neglected group of people. We don't have usually hundreds of millions of dollars. People are trying to get money out of us for X, Y, and Z reasons. We don't know any better in a lot of cases. And a lot of what I teach as a consultant, a lot of what our team teaches as consultants, I do it because I just didn't have this resources when I was growing my company. And I built this firm, started when I'm 52 years old. I started when I was around 40 years old. And I wanted to make sure that we do everything we can to make sure small and medium-sized businesses have all the resources they need to crush it. So on this topic, today is about the fact that 15 years ago, before I really got a lot of advisors to help me out, I had no confidence that I could ever sell a business. And I had no idea what that even really meant at all as an entrepreneur, maybe 20 years ago. But I had no idea. I was like a lot of entrepreneurs. I thought I'll sell my business when I'm in my 60s because that makes sense, because it's like retirement. That's very, very wrong. But that's what I was thinking. I was thinking my business, I didn't look at my business as being an asset. I didn't know, I had no idea. I had no idea what selling a business even meant. I really just, I didn't think it was going to be an option for me. I was really focused on just making money. I just want to make money. And, luckily now, we've worked with 150, 175 clients later. I know that I was completely wrong. Everything I thought about business until my late 30s, I didn't know any of it. I didn't know how the world actually worked. So the purpose of this webinar is to kind of give you a glimpse into what selling a business actually looks like. And a lot of you may not sell your business the next 10 years or 15 years, or you may sell it next year. But I want you to look at your business as an asset. And that's really important to me personally. So if you work with our firm, we're really passionate about making you look at your business as an asset, knowing what the value of that business is and seeing how it fits into your overall financial portfolio. So this webinar is about getting you to think, not necessarily about selling your business, but knowing what that looks like as a potential option for you and how to think about that question and really what that might mean and look like for you. And the second webinar will tell you how to actually get that done. Now, I will give you a minor caution here, and it's going to sound weird. Every time I bring in our advisory team and people say to me, including Charlie, actually, I say, you should at least look at how to sell your business. Usually the first thing our people say is, I'm not going to sell my business, Eric, until I'm 60, right? As if that's some magical number. Okay, well, I don't think you should sell your business either, but I do think we should get an evaluation and start getting some strategies to make sure that we're growing it to be really valuable so you can sell it at some point. And then I bring in the team, the M&A people that we have, the people that do valuations, and Derek, and then I say, okay, let's figure out what your valuation is. And then the entrepreneur, and then people say, thank you, I am selling the business now. And I'm like, don't do that. I didn't say that. I just want to figure out what the value was. No, I am out of here. And that's what happens. So I'm telling you right now, do not think this webinar is actually about us trying to tell you to sell your business. We just want to make sure you know what it looks like. And we want you to start looking at your business as the valuable asset that it is, so that at some point you can say, now I know I spent my years building this asset up. I knew when to sell it. I knew how to sell it. And I made myself whatever your version of wealthy is by doing that transaction. So that's the goal of this webinar, is the thought process around that. And then number two will be really around how to get that done. So we are going to start by talking about Charlie briefly. Charlie, can you just give us, I know we just gave a bit of background about you. Can you just give us maybe a minute around kind of where you are, when you sold your business, what that looked like? You can go in as much detail as you want or not, it's fine, but just a kind of a snapshot where your head was, when that happened, and kind of where you are in life now. Just a minute to kind of just get our head around who the guest of honor is.
Yeah, sure. Thanks, Eric. Good afternoon, everybody. So I started in the veterinary business in the mid 90s, had an opportunity to start essentially from scratch, by which I had a location, and it was myself and one relief veterinarian and a support staff member. It was just the three of us, and we started out. Fast forward 27 years later, we grew it to 4 locations and 140 staff and 40 veterinarians, and really just tripped into the thought of selling our practice or the businesses. And then in early 2000, actually got that transaction done. And now I'm more or less just consulting with the company we sold to, and really trying to spend a lot of time with my family and enjoy the ride a little bit.
So how long ago did you sell, Charlie? When was that transaction?
We started kind of working on that transaction in 2000 and 18, and then ended up selling and partnering with a private firm in early 2000, February of 2000.
2020.
2020, yeah.
Okay, got it. Got it. All right, thanks, and congrats. As a person that's watched you do that, Charlie has had the quintessential entrepreneurial journey, the difficulties, and the success that comes with it. He's really lived the package. So have many of you on this call, actually. So let's start with our first question of what it actually means to sell a business. And it's not always what you think. So I'll give some color on this, but I'd really like to start with Darren on this one. What are the types of transactions that can happen, Darren, and to who, and how do they kind of look? What's the gambit of options there?
So start with answering the question, what does it mean to sell a business? Selling a business is selling your business is selling a controlling stake in your business to a financial or strategic buyer. The difference between the two buyers, financial buyers, would be private equity or venture capitalists, folks that manage a pool of capital and use that pool of capital to make investments in operating companies. A strategic buyer is likely one of your competitors or somebody in a complementary space. And so what does it mean to sell a business? You're selling a controlling stake in your business to one of those two buyers. And then to facilitate that transaction, you're giving up voting and often operating control of your business in exchange for consideration. That consideration could be cash, debt, equity, or some other note or contingent consideration.
What is a typical percentage that's sold for? What percent they typically sell of the business when they do a transaction?
Yeah, I mean, so a controlling position would be 51% or greater from voting control. Typically, you're going to see transactions close to 100%. You may retain a small sliver of equity for the management team or roll over some equity. That could be part of the contingent consideration, or a part of the consideration could be a portion of the equity rolling over. But it's going to be close to 100%. I would say 75 to 100%, save for some rollover equity or carve out for management. Often you'll buy a controlling interest or 100% and then issue new equity if it's a private equity player to the key members of the management team. So again, you're going to be pretty darn close to 100%.
Yeah, thank you. So a takeaway from this one, Derek raised his hand. Derek, go ahead.
Just that's a great definition, Darren. Thank you. Just to further clarify, the waters have gotten really muddy. So Darren was talking about strategic versus financial buyers, and I think we're going to talk about private equity a fair amount today. But 20 years ago, when I started working with business owners on transactions, if you were a lower middle market company, and these terms can get they can get a little confusing, but if you're, say, 10 million in enterprise value to 100 million in enterprise value, virtually 100% of the time you were selling to a competitor. That's a strategic. Okay. What happened is private equity, who used to do big global multinational deals, they've come down market so significantly that the majority of the time when we see a deal in the lower middle market now, so 20, 30, 40, $50 million deals, there's some private equity in there. So it might be a competitor of yours, but that competitor actually is backed by private equity. So really important to kind of understand the landscape here. I just wanted to add some color to Darren's initial comments.
Awesome. And when we sold our business, we sold to a private equity backed strategic. So exactly what Derek is describing was the exact scenario when we sold the biopharma packaging company.
We could do another webinar on Darren's sale at some point. Darren sold almost by accident in between quarterly meetings. So there you go. And that was an extremely profitable exit, almost by surprise. There's lots of ways you can sell a business. So to sum that up, for some people that are less smart than those people, i.e. me, you're going to sell your business anywhere between 80% and 100%, usually 75, Darren's numbers right, which means that in a lot of cases, you might stay in the game, i.e. what Charlie did. He may talk about that. And if you stay in the game, you might get what's known as a second bite of the apple. And our goal when we're helping companies is try and get them to partner with somebody where not only can they get that first transaction, but they can either stay involved or become an investor in that second wave as their company grows. Because really, when you sell your business, you're selling it to somebody who you think can create a bigger transaction for you potentially in the future. So understand that. It's not as black and white as people think. Let me go to the next question. When do I sell? It's a big question. When do I sell? Let's start with Derek. Derek, what mindset do I need to be thinking about to answer that question?
It's a important question, if not the important question, Eric. Thank you. And let me first say the answer might depending on your situation. In other words, do you have investors? Are you venture backed? Do you own 100%? The interests might be there might be more than one interest in mind. But when I think about when to sell a company, there's really three pieces to it. It's what's the right time for the business, what's the right time for the market, and then what's the right time for the owner or the ownership group. So you can be, ready to go. Everything makes sense for you personally. The numbers would be great. The company is at the right time. And if the market's just not ready to do a transaction, it's not going to happen. So think about early innings of COVID, the M&A market froze, right? Nobody knew what the heck was going on. Nobody knew how to value businesses. So in, June, July of 2020, you could have been ready. The company could have been ready. The market wasn't ready, right? And so right now what's happening is interest rates have moved dramatically over the last year or so, and what that means is there's been an impact on margins, on multiples for private equity. So because their cost of capital has gone up, their models say that they can't pay the same multiples they were. So the way that translates to the people on the call is, hey, in our business, everybody sells for 10x, whatever. Revenue, EBITDA, depends on the business. Whatever the multiple is you have in mind, that might have changed due to market conditions. So we're talking about what's the right time for the market, what's the right time for the company. So in some cases, a lot of cases with the clients we work with, they might get to a place where the leadership team or the founder is just over their skis. They were great at 30 million in revenue, but to get that company from 30 to 100 million in revenue, it's going to require a different skill set. That might be the right time for the company, for example. And there are lots of different examples of that. The one where we come in most often is what's the right time for you personally. So the way that this concept gets on the radar screen of a lot of owners, in other words, should I sell my business, is somebody reached out to you. There's an inbound inquiry from a private equity backed company that says, hey, we'd like to buy your business. And now we start thinking about it. And usually there's a big number associated with it. So in some cases, that number might not be enough. I've met a few business owners, nobody on this call, but who has some of their personal expenses running through the business, and they might not really know exactly what their cost of living is, but getting really clear, and maybe Charlie will talk about his situation, but getting really clear on what would the amount of money need to be. Eric says, what's my number? What would the amount of money need to be able to do the things that you want to do, live the life you want, take care of the people you love and the causes you care about? And this is why, and I'm going to stop in a second here, but this is why it's so important to have this conversation early, because there are a lot of things that you can do on the front end that can save money in taxes, that can make sure that you're prepared, that can make sure that you have the information you need to have a successful transaction. So when do I sell? Right time for the market, right time for the company, right time for the owner or ownership group, and getting those three things to align, that's where the magic happens.
And that's what Derek's firm does so well. Is Derek's firm, the reason we partner with Derek's firm is because he specializes in working with entrepreneurs, and he helps them figure out, what is my number? What is my number? Everybody has a number. And it's just, and you should figure out what that is. I would suggest figuring out sooner rather than later. Maybe it's 20 million, maybe it's 10 million, maybe it's 5 million, maybe it's 100 million. But the thing that we care about in our business is helping companies figure out, what is my business worth now compared to that number? And the reason that matters is because, and I know that there's a lot of advisors here, because I know how many advisors we have on this call that I respect greatly. They don't always love it when I say this, but if your business is already worth more than what your number is, I would encourage you to understand, not that you should sell necessarily, but understand that business is risky and that your chips are on the table. And if your number's 20 million and your business is worth 25 million, I would say you should look at potentially selling because you already won. And I know you're like, well, I can make 50. If you determine your number's 20, you don't need 50. And in that delta can be a problem. So one of the things we focus on in the consulting business is helping clients figure out what is your actual number? What do we think your business is worth? What's the delta? How can we help you get there? And just have you know that information. What you do with it is a different story. And now I'm actually going to turn to Charlie and ask him the same question. Why did you sell when you sold?
Yeah, so we we started our company in 1996. We wanted to build a pretty strong, stable company, and as we all know, that's a hard thing to do. We really focused on wanting to grow organically over time, and then eventually we got to a point where we wanted to start to acquire practices because we felt like we had a proven model. We had signed up with Eric Cruz and company to help kind of build business process and build a nice stable company with good profitability. In 2014, we bought a new location, and through that process, we kind of learned a lot about what it means to value a company, what it means to buy a company, what we were looking for when we bought another location. We did end up buying that in 2014, and it was like I said, a really good learning process. And we took a model that we felt really confident about and used it at that location, and it became very successful. And so we wanted to continue to grow by acquisition, and we had made an offer on a pretty large entity, and we had lost the sale to someone else. And it was kind of a off the cuff conversation with the broker. I asked the broker, I'm like, so what did it sell for? And he wouldn't tell me the dollar amount, but he told me the multiple, and I knew the profitability. So, because we'd done all our due diligence, and I was like, that's a ridiculous amount of money. And he goes, literally, there was like a 30-second pause, and he says, maybe you should sell. And I was like, we're not selling. That was never even in my mind. Like, we're trying to grow this thing. And so we kind of dismissed it at first, but then it really became one of these questions that we really started to ponder. And as Eric said, what was my number? And so we really started to process that and think about it. My partner's 10 years older than me. So, he was really kind of closer to retirement than I was, kind of your typical, hey, I'll retire when I'm 60, and he was 60. So we started to really seriously consider it. And that's when we got Matt Rudnick involved, and Eric, and so forth. So, but yeah, that's how we ended up kind of looking at it. And, a couple things that helped me is I started to listen to podcasts by Guy Raz, who's really incredible, how I built this. And also listened to a lot of podcasts by Paul Ollinger called Crazy Money. Incredible podcasts, are very helpful to me, very insightful.
Awesome. Non-typical small business owner actually sold because he'd done some homework, and he realized the right time for him to sell was when he hit his number, and he hit his number, and that was that. Very impressive. What advisors do I need to get involved with in order to go through a transaction? Charlie, who were the players in your world of advisors that you had during that time frame? What were they? Who were they?
Yeah, so we've been working with a CPA for, since, we started the company. So very early on, 20 plus years, and also a lawyer very early on. So we had a good kind of strong team from that perspective, but and we've been working with you at Cruz and Company, and also very important part of our team. We needed to round that out, as we discussed on the last question. I really needed to know what my number was going to be, and so I'm a belt and suspenders kind of guy. I don't take things lightly, and I don't like risk. So finding out that number and working with Derek Muhammad and his team was incredibly helpful and a very eye-opening process, because sometimes you think your number is X and you really find out it's Y, and you really have to build in, or at least what I did is really wanted to build in a lot of cushion for those things that come up, extra taxes, extra expenses, whatever those costs might be. So Derek was very helpful with that. And then Matt Rudnick, we really needed someone to run the process for us in terms of selling the company and preparing us for that process. I learned a ton from Matt, and I just learned a lot about, we did not sell to a strategic, we sold to a PE firm. And that was a very conscious decision on our part, ours being mine and my partners. And Matt really helped us kind of understand that entire process and what it meant to sell to a PE firm. So those were the people that we worked with, and still work with a lot of those guys to this day.
And I think he covered the gambit. Derek and Darren, anything to add on that?
Yeah. So investment banker to run a process, a couple things, specialty counsel, things will come up, regulatory matters, ERISA, environmental, patent attorney.
Yep.
Having somebody at least on the ready, I think, is important. Accounting and tax counsel. And then I would say insurance and benefits advisors to help field and navigate questions, depending on the extent of the due diligence. But if it's a private equity or a very sophisticated strategic buyer, be prepared. It's going to be, due diligence is going to be fairly exhaustive, and you want a C-suite team of advisors.
Yeah,
Awesome.
and
Derek?
as Darren said, sorry to interrupt, we did bring on an additional attorney other than our normal kind of business day-to-day attorney. That was incredibly helpful in terms of running the sale of the company and doing all those things that Darren just mentioned.
Derek?
Yeah, I don't know that I would add a category here. I just want to highlight the importance of having true specialists in the field, right? So Charlie mentioned he had an attorney for a long time. He had an accounting firm for a long time. It's critical that these people have deal experience, right? I'll take this out of M&A and come back, but when we talk to clients about estate planning, it's really important that you have an attorney that does, like, that's what they do. It's not somebody who does family law on Tuesdays, real estate closings on Wednesdays, and they dabble in a little bit of estate planning. When we're talking about M&A, look, let me say this clearly. This will be the largest financial transaction of your entire life. You need to have people who do this all the time. So let me just confuse most of the people who aren't deal people. You could have a number that works, but if it's an asset deal versus a stock deal, and I'm not going to get into it today, but the point is the net number to you is significantly different. And if you don't have people representing you that know what that means, you're going to mess up the largest financial transaction of your life. So the message is, yes, definitely attorney, accountant, wealth managers, investment banker. These are the categories, but you got to make sure that you have people who are specialists. They do a lot of deals. They're not dabbling in M&A.
Love it. I'll add one more thing, and then we're going to talk about business worth. There are different categories of all of those things, as Derek just said, and one of them in particular is the banker itself who sells the deal. So I get this question a lot: how do I sell my business? And there's categories of people that should sell your business. You might, if you have a smaller business, I would say I'm gonna ballpark here. Under $1 million or $1.5 million, you can use a business broker. We know some good ones, and there's nothing wrong with that. There's a lot of good leverage there. We do work with Matt Rudnick, Main Sheet, who's here, but he'll be featured in our next webinar. He's going to go through how to do this in detail in that webinar, how the whole process works, so you can see it. He specializes, can do a lot of different sizes, but he's going to take your companies that are usually somewhat under your $5-ish million in EBITDA, maybe even lower than that. I would actually, to be clear, if some of you are like, I'm at 500 in EBITDA, Matt's going to really, he's designed to help small businesses. If you say I'm at 500 grand, at 250, I'm $1 million, he's going to help you. And then we have people that are on this call actually that are clients that can help you if you're over that $2-3 million hump as well. So there's different sizes of bankers, but we really have access to all the different groups, and we understand the differences in them, and some will want to deal with your transaction and some won't. But we're connected to advisors that will help you at every size because we have to be. So if you want to know who's going to help you, we can let you know. Let's talk about what your business is worth. I'm going to start this very clearly and say something that's going to be you're going to be like interesting. Your business is not worth what you think. it is likely either worth way more or less. Ha! All right. That's why I get paid the big bucks. So it is probably not, though, worth what you think. It just isn't. I've never seen a transaction. I know we got a bunch of bankers on this call. I've never seen a transaction where people are like, I want 10 million. Oh yeah, well, there you go. There's your 10 million. Doesn't happen. I wanted 5 million. We've seen people that wanted 10, they got 20. We've seen people that wanted 10 and find out it was really worth 5. And they're like, uh-oh, I didn't know that. You got to know what your valuation is, at least in general. Now, there are complex ways to value a business. Okay, so I want to be very clear. We are about to give you no hard and fast ways to do it, because you should do some research. But I can tell you this. It's not that hard to figure out what your business is approximately worth, depending on the market that we're in. It will vary by market, no question. Darren, what is the... Remember, Darren, think basic. I know that you're extremely smart. So I'll be careful on this. Darren's dangerous here, this question. Darren, in very basic terms, how do I figure out what the business is actually worth? What is it based on, and what are the languages around that?
Right. So I would say a sort of a blanket statement is that every business is worth the discounted value of its future cash flow, right? Doesn't matter the industry, doesn't matter the company. It's worth the discounted value of its future cash flow. When you hear a multiple of revenue, multiple of EBITDA, multiple of operating income, that just serves as a proxy to do that calculation. And that varies by industry. So companies in high growth, high margin, stable sectors will command a premium. Maybe they'll trade at 3 times revenue, 15 times operating income. Businesses in those sectors with exceptional product market fit, stable and growing cash flow, blue chip talent, they're usually positioned well in that sector, typically set apart. So you've got proxies for market multiples, vary by industry, and then inside of an industry, fast growing industries, higher margin, predictable cash flow would command a premium. And then companies inside of that industry that have set themselves apart, superior talent, product market fit will command a premium even to that. So blanket statement, discounted value, future cash flow. Proxy is a multiple of revenue or earnings, varies by industry and company. Usually you can get a private market valuation, but for the most part, a lot of transactions are publicly announced, and you have publicly traded companies, and you'll see these companies hovering around similar market multiples, with the exception of those that are outperforming or underperforming. And so you can get a pretty good indicator of what those multiples are. One of the things that I used to do, and I would recommend all of you to do this, have conversations with bankers in that space, have conversations with private equity guys that are in the space, have conversations with other industry players as well. You know, you're at a conference, hey, I heard, XYZ company sold. Do you know what the multiple might have been? Trying to get data points, as many as you can, on your industry, on your sector, and then think about how you're positioned relative to your competitors.
Thank you. So you're looking at a multiple of your earnings, can be between 10, 8, 15 times, more sometimes, less other times. That's times profitability. There's more to it than just that. That's the basic version. You might have somebody say your business is worth X amount times your revenue. Darren nailed it. You're basically just selling future cash flow.
Yeah.
But that's the formula. Now, I'm going to say something that I want you guys to hear, because this is Eric Cruz at 52. Idiot Eric Cruz at 40 didn't know any of this crap. So this is the purpose of this webinar. We have a 3-year business plan, financial plan for our company, broken down, pretty detailed, of where we think we're going to get all 3 of our companies in 3 years. Accompanied at the bottom of those business plans is what we think the approximate valuation formula is for every one of our businesses. Everybody hear that? You need that information. I can tell you what I think my approximate net worth is right now based on my business valuation if you ask me. Why do I know that? Not because I'm trying to sell the business in the next couple of years, but because I understand that my business is an asset, and I want to make sure that that asset is my biggest return ever. And the only way I can do that is if I benchmark what the formula is now and do whatever I can to maximize that value through the life of the time that I own it. And I will tell you in brief, to bring this down to brass tacks, I have a commercial painting company. We believe it's worth about 0.7 to 0.8 times revenue. It's a cash cow business. Some businesses are worth less than others, and that's one of them. Our goal is to get it to $2 to $3 million in net profit for 3 years. We have a strategy to expand into at least one geographic territory to prove that. Our theory in that business is that we're trying to sell it to somebody who sees it's going to be a $2 million plus net profit business that has expanding ability. That's our entire strategy. So it's a 0.7 to 0.8x times revenue. If a finance business we think is worth between 8 and 10 times EBITDA, we're fighting on that a little bit between Darren and I. I think we're going to try to get some IP in there. We have a strategy to get IP in the business to make it more valuable. All we're trying to do is up the value of the multiples. That's it. In the consulting business, we think it's worth somewhere between 12 and 14, depending on the market. So we focus on net profit. We got to get it to at least $2 to $3 million in net profit for a sustained period of years. Usually you're looking at 3 years is ideal. You can sustain $2 to $3 million or whatever your number is, $1 million or 500, whatever. They're going to look at that past 3 years. They're going to give you a multiple, and that's it. That's how it works. So I strongly encourage each of you to figure out the value of your business within a ballpark. Darren nailed it. Go to a conference, find out people that sold, ask them how much. They'll tell you. They have big egos.
Yep.
Ask them how it was figured out, and now you got a value of your business. Okay? Very, very important.
One thing I will say, Eric, EBITDA will often be the metric with private equity buyers because they often, and Derek had talked about this earlier, they'll bring in debt, not often, almost always will bring debt into the transaction. And when you have debt financing, you need EBITDA, earnings before interest, taxes, depreciation, amortization to be able to service the debt. So lenders will lend against EBITDA, private equity buyers will buy off of EBITDA. And that multiple depends on the industry and depends on how you're positioned in the industry.
That's correct. And your job as CEO, Derek, now I get to see your hands up. Your job as CEO is to maximize the value of your business. That's what your job is. So if you can't figure out what the value of your business now and you don't have a strategy for your investors, believe it or not, you have investors. It may just be you, but you have very important investors. You need to maximize the investors. So not only should you have a valuation, you should have a strategy and a basic timeline as to when you think you're going to sell and a basic plan to make sure you're maximizing valuation between now and then. And that usually involves things you're not currently doing. Derek?
I agree with everything that's been said. Just an little bit of additional color. First thing is business valuation. There are a lot of different types of valuations. So what we're talking about here is what's the value of your business in a transaction.
Yeah.
There's different kind of a business valuation of 409A if you're doing, if you're doing stock compensation for your employees, if you're doing gifting for estate tax purposes, you might want the value of your business to be low so you can maximize the value of that gift. So lots of different kinds of valuation, but ultimately in an M&A context, your business is worth what somebody's willing to pay for it. Right. And so here's a plug for Matt Rudnick and Greg Rush and some of the other folks that are on the call. And this is what Darren was saying. I think it's worth reiterating. You've got to talk to a specialist who does deals in your space. They know what the value drivers are of companies in your vertical. And I'll just share an anecdote very quickly. We had a client, local company, went through a process, hired the team, got a competitive auction process going. 15 million top line, just under 4 million EBITDA. They sold for $120 million. There's no valuation model on that. It was a publicly traded strategic that bought them. $120 million was a rounding error, and they had some little thing that the public company needed. So the point here, I think, Eric, correct me if I'm wrong, but everybody here should have an idea of what your business is worth on the open market.
That's correct.
You need to have conversations with specialists who are doing transactions in your space to give you a real read on that.
Derek, you bring up a good point. A strategic may pay a premium because your EBITDA may not be their EBITDA, meaning if you have 5 million EBITDA after the acquisition, they may be able to generate 8 million EBITDA because of various add backs, synergies, and so on and so forth. And so you'll often see a premium, like in the case in Derek's transaction, it was a bit of a rounding error, but my suspicion is there was a lot of synergies embedded in that transaction as well. So while the multiple on its face appeared really high, when you looked at the pro forma multiple after the transaction, it might have been materially lower because of all those add backs.
Love it. So we're going to see if we get one or two more questions in. I know I'm sensitive to time. We got 15 minutes left. Last thing on that, just as a reminder, you got to run a process.
Yeah.
I don't care how big your business is. You got to get you got to hire some kind of banker, whether it's a Matt Rudnick or a Greg Rush or a business broker. Someone has got to create a fair auction for you. And if somebody comes to you and says, I'm going to buy your company for this price, remember that is your first offer. You now need to run a process to get more offers. That's what you need to do. You're not selling this to one person. If you call me and say, what do I need to do? And you say, I have a buyer. I say, the answer is you're not going to sell to that buyer. You're going to run a process. You're going to keep that buyer honest. Okay. So, and we're going to talk about how to do that in our next webinar. How can I increase my worth in my business now? How can I do that? Charlie, let's start with you on that. What did you do to make sure you increase the value of your business throughout the time that you owned it?
So, a couple things. When we went to buy that fourth location, we did a bunch of due diligence, and as a buyer, as opposed to a seller, we really learned about what things are important when you're looking to buy a practice. And we started to really turn that into, well, if we're looking for that stuff when we're a buyer, we want to make sure that we have our ducks in order when we are potentially a seller. Not that at that time we were looking to sell, but it caused us to kind of try to run our business better. And so I think when it comes to increasing the value, one thing we really focused on is making sure that we had profitability and growth for kind of an extended amount of time. For us at that time, it was 3 to 5 years. We wanted to make sure we had a solid management team in place, which we worked really hard on doing, because having that team in place really kind of drove the engine of the company. We also wanted to make sure that our business would survive and thrive without us as owners, myself and my business partner, me being the business guy, my partners being 2 veterinarians. And so we didn't want the businesses to rely on our existence. So we were able to do that well in advance. The other things we did is we really wanted to make sure that our books were clean, organized, readable, so forth. We wanted to make sure that we really had kind of our ducks in a row on that front. And then, one other thing that we really focused on was developing a very strong culture in our company and running it based on core values. That was important to us personally. And it was also for us a way to run a company with people that we wanted to be around and ultimately be successful. So that was really important to us to get that culture kind of part right.
Yeah, and we worked with Charlie for almost 5 years. It was quite a journey. And a question I get a lot is, what do I need to do to get my company to be worth more? It's a couple things, and they're all important. One is to make sure it's running operationally well, strong leadership team, strong financials, all those things. You also got to figure out who you might sell it to potentially, and what you can be doing. Who are you going to sell it to, and how are you going to get your profitability up to be attractive to that market? Like, what are they going to be looking for? If you're selling to a strategic, you're selling to private equity. And Charlie really focused on cleaning up his finances and really focused on making sure that when he went to a buyer, and I remember this part of the process, they said, you're the most organized company we've ever bought. And ultimately, that's what they're buying. And ultimately, Charlie had laid out his vision, and I'm a big believer in this. So whether you're working with us or working with anybody else, it doesn't matter. You should lay out the next 3 years at least of your firm, maybe even have a vision for 10, because ultimately the more that's laid out and clear, that's actually what they're potentially buying, depending on who's buying it. They could be buying that future. If a strategic buys it, they may not want to buy that vision, but at least they can see that your business is tracking to do X, Y, and Z. You can show them the past data and the future plan, and that will make a big difference in your sale. Darren, anything else they can do to increase the worth of their company before they go into an auction process?
Yeah, Charlie, you nailed a bunch. I love the reverse engineering. That was true for me. My background in private equity, I sort of had the private equity cheat sheet, so I knew it was attractive. You did a similar thing. You found these to be attractive in acquisition candidates, so you knew that, well, if that's true for them, it's got to be true for me. I'd add a strong intellectual property portfolio. That's a key ingredient. Long-term contracts, company favorable long-term contracts, diversity of supplier and client base, and have a cohesive story, right? I don't want to see a lot of focus dilution. Make sure you stick to whatever your core is. Don't just chase revenue and chase profit. Have a nice story that somebody's going to find attractive, because often they're like, I really like your business, except I don't quite understand why you ended up with this particular revenue stream or this particular asset. So make sure you have a nice sort of cogent story, diversity of supplier and client base, strong IP portfolio, company favorable contracts, and everything else Charlie talked about, predictable cash flow. Last thing I would say is hit your numbers. Make sure you hit your numbers. If you have a budget, hit your numbers. Credibility is key. One of the things I always ask folks, I said, show me your last 3 budgets. And they did. And I realized they missed their last 3 budgets. So if they can't hit their budgets, why do I think they're going to hit their forecast that they're showing me? Hit your numbers.
Yeah. I could jump on that too a little bit. And Darren's absolutely right. We did budgeting process for our company for many, many years. And most of the years we hit it, we didn't always hit it. But the other thing that we did, and I think this is incredibly powerful, is we shared our financial statements with our management team on a monthly basis. Everybody had accountability to a specific account or line item on that income statement. And that became incredibly powerful because as a single owner, I can't run every expense. I need people to help drive revenue and help drive, very lean expenses. When you got a team of, 10 people working on that and really helping the staff through that process, it really helps profitability. And that was really powerful for us.
Awesome. Darren used a great word there, team, that we use a lot with our clients, and that is the word story. Remember that you're writing a story for your future buyer. You're going to sell your company at some point. All of you are. Trust me, you're going to die. So that's what's going to happen. Either you're going to do it by accident or you're going to do it intentionally. But that's the way life is. Your company is going to be sold. So you want to be thinking about, how do I write the best story, and how's it going to look to the future for the future owner of this company? How's my story looking? The better you can make that story, the better you're going to do with your exit, no matter when that is. See if I can get one last question. Is Darren, for you, around protecting the team, what can we be doing, or should we be doing with our management team or our core players now to help them get engaged through the process, or maybe even long term, that will help them either to benefit in a sale, if that's something we want, or help them for afterwards? How do we do that?
Sure. Without question, you should be thinking about some sort of equity planning for your key executives. And then depending on how deep in the organization you want to go with that, you're typically okay in a private equity scenario. In other words, your team is probably well protected. Private equity folks are often buying the team, and that's part of the attraction. Strategic is a little different than that. One of the things when you're going into a transaction, understand the intent up front. Ask them to put the anticipated plan for the management team in the letter of intent. Ask them to spell it out, or make sure that's part of an early conversation. You do not want to find that out halfway through deal negotiations. For folks that don't have equity, you want to make sure you've got some sort of transition bonus in there, a stay bonus, a severance arrangement. And that protects both the buyer and the seller. The buyer is going to want to see a transition plan in there as well, or a stay bonus. And the stay bonus will protect those individuals for a period of time. If they're terminated prior to that period of time, that stay bonus is accelerated. If they stay on for that period of time, that stay bonus is paid out. And so you can see the benefit for both the buyer and the seller from a protection standpoint. Employment contracts, also important as well, depending on the executive level. Usually at the higher C-suite level, you're going to see a lot of employment contracts. The only thing I would advise against is to be super careful not to tie an individual to a deal. You don't want any deal risk, any deal holdup whatsoever. So broad conversations around equity, transition bonuses, putting that stuff in place, that's wonderful. But don't specifically link things to individuals or have long-term employment contracts that are conditional on closing. Do not make closing conditional upon key executives.
Excellent. Thank you. We've got 5 minutes left. I want to say a couple things, and I'm going to ask anybody's got Q&A. I know people are going to probably start dropping off in a minute. So just want to wrap up by first saying, before we go into Q&A, I want to thank Derek for being here. You've been a phenomenal wealth management partner for our clients. We're very grateful. You help us to get the numbers that we need for our clients, and then make sure they're financially secure for the rest of their lives and their families are good. We thank you for that and for being here. Darren, thank you for just being you. Many of our clients work with Darren, as you might expect. He helps, whether it's a one-off where he just helps our clients whenever they need it, or whether it's on a monthly basis. Darren, you're amazing. We're thankful. Charlie, you're a very dear friend and a wonderful client of ours also. I couldn't be happier for you. I wish I was in Hawaii with you, but incredible. I'm very grateful you were here to share your story so openly and honestly. And before I ask for questions, all I want to say to the group is, it's very easy to fall into a mindset because business is very hard. You get yourself into mindsets where you're struggling, you're battling, and you're just thinking, I just need to make more money. I just need to make more money. I need to make payroll, and you don't lift your head up and you don't have time to look at your business as being an asset. And I can tell you, I would not make the mistakes that I made. Look at your business and asset 10 to 15 years earlier than you should. Figure out what the valuation is and be very cautious that your business is probably your biggest savings plan. And you got to make sure you take care of that investment and start treating it like that. And you want to know that sooner rather than later. And don't think to yourself, well, I'm only 35 or I'm only 40. I'm not going to sell this business until I'm older or blah, blah, blah. Do your homework, figure out your valuation, do the work that needs to get done. And don't think that you can't have whatever exit you want if you're smart about it. Any exit you can have. You just got to be smart about getting it. Questions from the audience. Does anybody have any questions? We got one question sent to us, maybe more. One that I saw, which is, what if I'm $1 to $4 million service business? What do I do? Who do I use for to help the transaction? I would say that might be a business broker potentially at that size. Depends on your EBITDA, or we can refer you to Matt actually, and Matt can probably help you figure out the next best step. Either somebody like him can handle that transaction or somebody else. So email us, whoever sent that question, and we'll either pair you up with somebody like Matt who can do the transaction, or a broker that we can work with at that size. Either one works. Other questions from the audience?
I have a question, Eric, from Tom.
Shoot.
His question is, how do you determine the value of your company being a services company?
So if it's a services, so the way we do it is, first of all, there's resources for that. So first of all, send me a direct email and we can probably, and by the way, I know one of you on this call right now, I owe you a response to. So I know you, I won't call you out. I owe you a response, and I'm sorry. So we get this question a lot. If you send me an email, we can help you. What we're going to likely do is look at what competitors in your space have traded for. It's not that hard to figure out. There's deal boards you can use. Matter of fact, you can use deal board. And they'll give you a valuation of what the service businesses in your exact space trade for. And you can actually look to see what they've traded for, and we can get that answered for you. It's much easier than you might think. It doesn't mean you can hang your hat on it. It depends when they sold. It depends what your actually profit is. But we can give you a ballpark on that number relatively quickly if you call us. Other questions?
What about considering an internal sale versus external sale?
I was waiting for somebody to bring that up. Darren, that's you. Go ahead. What do you got on that one? There's a lot of versions of that one.
There are a lot of versions, although I would probably still recommend running a process, whether you're evaluating an internal exit with whether it's one of your partners or an external, bringing in a banker to at least have a good handle or understanding on what the market might bring to that transaction. I mean, we ended up, when we sold the business, we ended up selling to a strategic, but prior to that, we were entertaining actually a minority interest from private equity. We're looking for growth capital. And to be frank, the range in values was pretty dramatic, depending on who was interested in making the investment and how they actually looked at the business. So long story short is you need to run a process, I think, regardless, whether you're selling internal, external, you're just going to see a tremendous amount of valuation range and different perspectives and even different deal structures that could be more or less attractive. So I highly recommend running a process.
Excellent. We'll stay for a couple of minutes afterwards too if we have more questions. But I'll let Derek answer. I'll let Derek answer his question. The other reason for that, Darren, is it's also possible when you run a process and get the actual valuation of your company, the person you thought internally you might sell it to, they might just see the valuation of the company and say, forget it. Instead of giving me buying the company, why don't I just take my percentage of that number and let's just sell to them instead.
The only thing I would say is ultimately you may end up selling internally for a small discount if you're comfortable with it, because there might be less issues from a transition culture standpoint that, you might be beholden to your employee base. And so there's an appeal there as well. Don't discount that, right? The culture, the impact, like you might hit a number and say, you know what, that number is more than enough. It frankly doesn't matter. This guy can pay a 10% premium. I want to sell to my partner. I like the fact that I know the employees are in good hands. So that's the other consideration, but at least run the process to understand where that valuation range is.
Okay, Derek, we'll get to your question. Everybody else, it is one. We're going to stay on board and keep taking questions. I just want to say in closing, if you have questions about any of this stuff, just reach out to us. Eric@cruiseandco.com, or you know how to reach all of us. We're here to help you. We run companies through our system and this whole process all the time, but we'll keep taking questions. Derek, go ahead.
Just along the lines of the question about selling internally, typically when you hear that, you think about, there's a natural successor and, they're going to buy you out over time or something like that. There is also an ESOP transaction, which gets brought up in this conversation quite a bit. So it's an employee stock ownership plan. Don't have enough time to unpack it today. Really, really complicated. I would say, 1% of the time where you start talking about an ESOP transaction, do you actually get it done? We've actually seen it. There's some incredible tax benefits if you do that. There's a section in the tax code called 1042 where you can exchange your basis into shares of long-term corporate bonds and not pay capital gains. So an ESOP transaction is something that comes up as part of this discussion. I think for today, I'll just say really complicated, and this is why you need to have experts around the table, especially if like your burning desire, what feels right for the company, for your customers and everything is to sell it to the employees. You should be talking about an ESOP.
Thank you, Derek. Other questions from the group, any kind? Okay. Thank you to everybody. You're our tribe of people. We're grateful. Your clients, we're grateful for your clients. We've been entrepreneurs for a very, very long time. You can do it. If you want to sell your business, you can get it done. We're thankful. Panelists, thank you very much again. Bye, everybody.
Thanks, everybody.
Bye-bye. Have a great day.